Welcome to Get Serious, where at Serious Land Capital, we have successfully funded over $6.5 million worth of land deals with industry-leading 41% operating margins. I also serve as an AI consultant for companies cumulatively doing over $50 million in annual revenue. So today, I really wanted to dive further into real estate macro reports and how to really assess the market, just because there's so much spin thrown in here. Like it's one of the most difficult areas to really grasp and get an idea on what is actually true or not, because some of these reports can be like things are really turning around within real estate. Other reports are like, yeah, this is still one of the most difficult, if not most difficult, selling markets in the past 100 years in the US here. I think the evidence is more toward that latter point here. But again, we have to view all the data that comes in through as an objective lens as possible. So I just wanted to dive in. Again, we could done a whole bunch of podcasts about this, looking into past real estate cycles and so forth here. So, we can't dive into every single metric, but I want to clue you in just as far as a statistical overview and how to think, again, more like a scientist. A lot of this I learned back in my medical career and trying to apply that from a real estate perspective. So we can understand how to actually sort through the numbers being presented in front of us, where to dig deeper, where to be more skeptical, and where to really, take a more firmer understanding or firmer grasp on particular numbers that come our way that might have a greater or more solid foundation behind them versus some that are potentially a bit more flimsy when we dive into it. So, and again, we always have to keep in mind like the incentives, who is presenting the information in front of you. Everybody has some type of bias, some type of incentive, something they're trying to sell you. Like that is just the nature of all information being distributed. I don't know if there's any like truly objective source out there. And whenever it's to me, it's always in vol ravacant Latin phrasing, nullius in verba. Don't take anyone's word for it, including mine. So if you want to dive into any of this additional info, go ahead and fact check, go ahead and review. Like anytime I'm even searching anything with, doing AI background research and so forth, like any information that's coming in, and whether it's a well-renowned podcast guest, whatever, book that's highly regarded, doesn't matter. Like I have AI automatic fact checking. Okay, where are some of these claims? Do they line up with what the actual evidence is? The most gold standard evidence we have available. Some that needs to be corroborated further. Some like it's an unclear answer. Some that's like very counter to what the presenter is saying. So sometimes even when I do these podcasts, like I'll think back to it, later on, or maybe I come across some new information even over the next couple of days. Like, yep, didn't quite get that. So just keep in mind, everybody has some fallibility here. I try to be as well researched as possible when I'm presenting anything, but that's just a clue to keep your antenna up when it comes to assessing claims from anybody, including yourself or your past self. So with all that in mind, I recording this in mid-July 2026 here. Some of you all might have seen some of these reports that come over, like the PR news wires and so forth. Again, you have to, like, anytime you see news reports like this, like, again, we know this is public relations, right? So that shouldn't influence you. Hey, this is going to have some bias behind it. So in this case, it was a June housing report by realtor.com. So realtor.com, right? You just see within the name there. I really like the sites, realtor.com, Redfin, Zillow. I do think they have a lot of quality data behind them. Obviously, like they import raw MLS data, which is some of the best quality data you could ever ask for when it comes to real trends within real estate here. But keep in mind that they are websites that are really oriented towards on-market listings and the realtors and brokerages that are representing those listings. So you have to assume there's, again, incentives in play to potentially influence reporting that would encourage a more optimistic, or at least not like overly pessimistic view of the real estate market, because again, like their livelihoods depend on it. Even the, you know, technical and engineering teams behind these technology platforms like Zillow, they're not going to get as many hits on their website and, you know, incur revenue if the real estate market is not as active. So that's what I would really want to continue to key in here as we go through this. But, you know, critically in this particular report, there's a whole bunch of data here, and sometimes like it's hard to parse through all of this. So I'm going to try to do my best to like point out again where exactly you should be focusing on. But the headline here was asking prices over the entire country fell 2.5% over the past year, whereas pending sales actually rose 3.7% year over year. And they're noting this was the 7th straight month of growth. So that's kind of the headline there. Keeping in mind, well, yeah, we have to address the consideration of how long this data has actually been recorded here. So for this Realtor.com data, it looks like they had started recording all of this since 2017. So almost 10 years of data, like a pretty solid sample. But, you know, keep in mind, you're not going to be having the great global financial crisis, you know, the '08 period, or early 2000s and so forth here. So you're missing a whole bunch of other markets that were highly influential when it comes to significant market adjustments here. But, you know, 10 years of data here, like we've seen a lot of changes. All of us can agree on that, with a fairly balanced market, pretty bullish, I would say, in the last, you know, the end of the 2010s, and then extremely bullish for the first few years post-COVID, and then it got really nasty as far as having more sellers versus buyers really since mid-2022. So looking at this takeaway again here, if we see just the face value of this, asking prices decreasing, pending sales increasing, it's like, okay, we are starting to top out the market here. We're finally starting to soften on some of the pricing. People are more encouraged to come back into the market and start making some purchases here. Yeah. Looking at that, it's like, okay, yeah, really, you know, positive sign here. Maybe, you know, this is the time to really start trying to sell more inventory when you're looking at that. However, looking closer at the data here, well, actually, I want to go a bit more piece. I don't want to jump off those couple of numbers right off the bat here. First, whenever I'm looking at reports like this, and this is same like if I'm looking in other statistical studies for, you know, peer-reviewed medical research, anything like that, see, I don't know, for example, like a 30% decrease in breast cancer incidence, something like that. And this is the difference between relative changes in numbers versus absolute. So the relative is percentage here, whereas absolute is the, you know, true number that has actually changed. So, you know, if we had pending sales, like let's just use round numbers here. Let's say we only had 100 pending sales. I know that's like super low, but again, this is just an example. 100 pending sales a year ago in the month of June, and then 3.7% increase, which when you look at it, it's like, okay, this is like pretty substantial. When we're looking at the numbers here, certainly trending in the right direction, but from an absolute perspective, like that would only be an increase to like just below 4 additional sales. So like a very minor amount in absolute terms that diminishes the relative increase in you know, the actual you know, total number of sales that have gone pending within the national market. So obviously that's not the correct numbers, but even if we expand that out much more significantly, when you do look at those absolute numbers and, you know, total amount of pending sales, and you look at the number of sellers on the market versus buyers on the market, like it has been historically low over the past 4 years. And Reventure has data that'll often look at it, and just looking at, you know, total pending sales, we're basically at a nadir. Like it is as bad and as low from an absolute number perspective as it was like in the peak of the global financial crisis, the GFC. So we're looking at like '08, '09 levels. of where pending sales are at currently. And critically here, and I know this is something I've noted on before and written about before, is that like we've been stuck in this depression or really this valley for like 4 straight years. There have been like no noticeable changes in pending sales, like flat for four years at this point. Whereas during the GFC, it actually bounced back a bit quicker. I don't have the data immediately in front of me, but I want to say like it didn't last more than 18 months roughly before you started to see a bump back. So when you have something like that in mind, now all of a sudden, okay, a pending sales increase of 3.7% year over year, which again, like we want to applaud that. Like that is a better, like I would rather have pending sales, even if it increased 0.1 over a period of time. Like that's better than going in the other direction. But we have to keep in mind, like we are still at a historic low where, all the alarm bells should be going off as far as, lower amount of pending sales actually happening. And it's probably actually worse in comparison with the GFC because our population in the country was lower in that period of time. I don't know. Yeah. I think we have in the US like somewhere around 330-ish million people or something. You go back almost 20 years, I want to say it's closer to like 300 million. So, again, don't fully quote me on that one. I don't have that data in front, but like this is another cue. Oh, hey, you could look at this yourself if you wanted to. But assuredly, the population of the US is without a doubt higher than it was, 18 some odd years ago when we would look at the data. So that makes it even worse if the absolute number of pending sales is lower or as low as it was during the GFC because of the increase in population. So that just means like percentage wise, there's even less pending sales happening as a total population is concerned. So that's what I really want to throw out there because this realtor.com report is like really pinging in on that. And, I'm just going to buyers, just the way they were phrasing this. Again, sometimes you just have to like parse through the PR speak here. It's like, a headline, buyers keep responding, pending sales rise for the 7th straight month. Again, like you could look at that headline number. It's what a lot of people will attach on, but like I just broke it down for you why it's not nearly telling the whole story when we're looking at the true situation of what we're looking at. And so it's saying, pending status or the stock of listings in pending status has, extended the growth streak to 7 consecutive months, which we mentioned, the longest such run since December 2020 through June 2021. So like that's even cueing the reader of like, oh yeah, that was like a really bullish time in the real estate market. So I guess, are we like trending in that direction again? And, I'll credit them to saying like, hey, let's still man this argument a little bit. Like there's no sign that rising pending sales are masking a wave of broken deals. Like contract cancellations in April and May came in at almost 7% of pending sales, modestly below the 7.3% rate a year ago. So taken together, this data pushes back on the concern that rising pending sales are masking a wave of deals falling apart. Homes are going under contract and they are staying there. Like that is a good note there. So again, like they're starting to attempt to steel man their argument a bit here, but again, not really going into, hey, this is like still maybe the worst time in U.S. history in terms of pending sales in relation to the total population. So have to keep that in mind. They also note that time on market ends a 26-month streak of months in which homes sold more slowly than the prior year. Again, like that's good to note. And they do note, okay, median homes spent 53 days on the market, which is actually identical to the same month a year ago. So like again, it's like not the when you really break that down. At first, you're going to be looking like, oh wow, like 26-month streak. Days on market kept getting slower here, but is it really that different when we're looking at year over year data here and we're looking at June 2025 where the median home was on for 53 days and now it's 53 days again in 2026. So very, in my opinion, like limited in terms of the utility of that data. And that's telling me as well, like, okay, days ticking up, how much is it really changing? They don't mention across the entire nation, but they do break down the Northeast, the Midwest, West, and the South. And it's like very minute changes here. So like if we're looking at the Northeast, where we know some of the best performing markets are for actually moving inventory, it's like -2 days, right? Like hard to really build in a stronger trend looking at that. Okay, Midwest is actually +3 days. That's actually a note, a little bit more negative than you'd expect for a stronger market in the Midwest, +2 days in the West and flat in the South. So again, it really doesn't tell you anything. And if we're breaking it down from 26-month streak where the median home's on for 53 days, but we're seeing, okay, in two of the markets, the Midwest and the West, it actually got longer. The South was exactly the same, and the Northeast was just slightly less. So that's probably saying that there was more activity in the Northeast. So that actually decreased the total days on market here. So that's telling us, okay, Northeast, still a bit of a stronger market here. Everywhere else is a bit worse, and maybe even more worse than the data is telling us, because the time on market is not even being able to outpace one fourth of the U.S. roughly in terms of a geographical breakdown. That's driving most of that decrease on time and market, whereas everything else was stable or going up here. So that still to me is like a more negative view on that particular metric. So again, like I could point out a lot more of this. Like these are fairly data heavy reports here, but this is to give you an example on like, okay, what do each of these numbers actually mean? What decisions can you arrive at when we're looking at this? So this is the key thing about looking critical. And you could throw this into AI and ask like how do I avoid the spin associated with this particular data? I mean, maybe you can even create a prompt on how to look at that, but that's something that I would consider doing. And so again, you can really double check the claims. What does this actually mean? How do I corroborate this? But you also have to keep in mind that with AI, it might be pulling in a lot more other reports that are like these PR news wires. And so like it has to be guided to figure out, okay, what's the story behind these numbers, and why, again, you still have to have that ability to think critically and realize, is there still something that might be missing here, even if you do parse through AI and try to look for the guidance in the data out there. Because remember, it only has access to anything on the internet, and it's not able to think beyond that. So noting that, I'll jump in through a few other examples here. One is just to note that even though asking prices had fallen 2.5%, and the pending sales technically increased, it still didn't change the fact that the median sale price was a record high that the national housing market actually hit, just like a tick over $400,000. So okay, listing prices decreased slightly, but sales prices still up from that. And it's like, how do you kind of square that data here, where again, like we think this is like the most difficult housing market maybe ever to sell anything, but how is the sales price still keep going up? And to me, it's probably pushed up a lot more when we are considering more of that K-shaped economy and looking at the significant number of $1 million plus homes that are bumping up the average more. And that is a key difference to keep in mind, is like, okay, you're looking at the median versus the mean price. So if we remember back to math class from elementary school or middle school, whenever we learned this, like the mean probably would be even higher because that's the average, and you're going to get those massive outliers. Like, I don't know, I saw a sports fan, I saw like Anthony Davis's LA home sold for $30 million or something, like just massive. Whereas like you can only go closer to zero, like that you're not going to get as much of a extreme range on the lower end, just because there's not as much room to move. But houses, there's $100 million houses out there that could significantly bump the mean when you account for them. But even a tangent off that, like in that luxury market, like beautiful Bel Air home that this NBA player Anthony Davis had, and he actually had a listing price. It took like 9 months to sell, something like that. It was around like $39 million, which was, according to Zillow, like 30-ish% above the market value of the home. and selling for 30 million, it was actually like 25-ish% below market value. So it's even showing there in the ultra luxury market. Can you really get the listing price or even like the market value that's expected? Maybe that is softening a bit as well. But yeah, you're accounting for like the mean is going to be driving up those numbers. Yeah, if we're using the mean, the average, it gets wrecked by outliers. But the median doesn't care about that because that's just the middle value when all sales are sorted from cheapest to most expensive. Yeah, so that's right here. I was trying to remember how we did this back in middle school again, like the way you would sort out the median. Say you have like 10 numbers and you just start crossing out from each range. Like if I have numbers 1 through 10 or whatever. So I'm crossing out 1, I'm crossing out 10, I'm crossing out 2, crossing out 9. And I just keep crossing out one after another on each end until I arrive in the middle here. So that's why, you're not going to get wrecked by as many outliers, like the $30 million type of sales here. Same thing with like super distressed trades either. But it really tells, okay, that this is the actual middle to arrive at. Nevertheless, like still important to note, because to me that's still telling like K-shaped economy. You're still getting much higher price properties that are moving, that's still pushing up that median sales price even higher than expected. And maybe like the only people actually able to close on properties are those who are more well-to-do anyway. And so like that can just tell you a measure of the economy at the moment as well here. Also, there was one other key piece of data. Yeah, when I'm looking at the active listings, it's like around 11 or 1.1 million in June of this year here, which is like roughly equivalent to where we were pre-pandemic, but it's a change of 92.2%. So almost a doubling since June of 2022, which again, we think of that generally as like the shift from that super bullish market to a much cooler market here. Like that is a massive number to account for. To where it was like, yeah, you just, there was like no inventory available. Everybody was bumping up prices 4 years ago here, and now there's a doubling in inventory. That to me is like an extremely telling number. When I was parsing through all of this data, like, okay, yeah, so many people are just not able to move properties anymore, or it was like a lagging indicator. They got in too late once the interest rates started bumping up higher, and now they can't really move their properties. So that's another piece to consider here. And some people might look at like I'm looking at some Redfin data now that was also from June of 2026, and it's showing the months of supply at like 3.5 months. And so you might look at that as like, oh, that's actually like a seller's market, but it's so heavily biased from the existing inventory, where again, there's still so many people who are more in the lock-in effect or not really trying to move from their properties. But if you look at new builds, the months of supply is like north of 10 months, something like that. And I think that's averaged all across, fully homes that are complete, ones that are, lots available versus like land banked properties. And it gets higher, like that months of supply is like way higher for those latter two, like something outrageous. Like I think that when we're accounting for land banked properties, like that became such a boon of an industry over the past 5 years. But it's something like 20, I want to say it's like more than 2 years of total inventory, like the sky high numbers that we've never seen before since this started being recorded here. So like we have to keep that in mind. How to read into these numbers more thoroughly, and also account for, new builds are, a fraction of existing inventory when it comes to homes. So that's why like the existing homes are, driving down that months of supply number compared to new builds. But I would view the new builds as more of a leading indicator to where the housing market is heading for a number of reasons. So that is another piece to note here. And a handful of other things here before we wrap up. Just looking at some of the metros with the biggest year-over-year increases in median sales price. First off, San Francisco is just crushing it at almost 11%, which, when we're looking at it, it's like, yeah, all the benefits from the AI boom are like yeah, heading back to the Bay Area. So you're getting the Anthropic, the OpenAI, SpaceX IPOs, these big AI booms, and yeah, it's solidifying around the primary housing market. But interestingly, San Jose, right around the Bay, is actually the second worst metro in the entire country as far as year-over-year decreases in median sales price. So that to me is a pretty interesting note. It's not the entire Bay Area, but specific to SF in and of itself. And also noting that West Palm Beach is actually the second highest, biggest year-over-year increase. Again, almost 11. And even though Florida has been, getting kicked in the teeth in regard to reduced sales volumes, we think of the K-shaped economy again, like West Palm Beach, a lot of older, richer folks moving down there, and very limited space in which to build or have real estate like that. That's why it's trending on in that higher direction. So something to note on that end. And I'm actually looking. I'm seeing some of the roughly 4 months worth of data on the pending home sales tick up, and so we can actually see over roughly 4 weeks what the total pending home sales actually is. So I was naming like 100 homes as the actual amount. So like over roughly 4 weeks or so, you're getting about 300,000 homes. This does not really make sense. So this is like interesting. I'm looking at this data and it's not totally making sense to me. Because if we have 1.1 active listings in June, we're getting new listings like 400 some odd. So are we really getting 300,000 pending homes every single month here? I would look into that. And when I do this over the newsletter, I'll be able to answer that more thoroughly. But I even want you to hear my live thinking sometimes on this. Like, okay, I'm looking at these graphs. How do I really interpret these to ensure that I'm seeing the correct numbers here? Nevertheless, regardless of whether that's 4 weeks, 3 weeks, or even over the course of the whole year, we're looking at pending sales pre spring seasonal bump like in February of 2026. It was like 310,000 pending home sales, and the absolute peak that it hit was in late May for like 340. But now sitting in June, it was sitting around like 325,000. So it's really not that much of a difference, even at like the lowest part of the year to the most active part of the year. I'm just running these numbers now, like 305 divided by 325. It's 6 or 7% difference from lowest part of the year to kind of the peak of the year. It's like not a massive change. So just again, kind of something to keep in mind. Where in this case, we were actually looking at the absolute numbers, and it seemed like, oh yeah, it's a bigger trend here. But we're looking at the relative. It's actually not that much. That's kind of driving real activity here. Last piece to comment on, and I'll go quicker as we got tied into so many of these, is that an article that was noting just Americans' dream of home ownership, which is still like a huge dream. Like almost half of Americans, like when we consider the American dream, most Americans consider owning their own home to be like the number one factor when it comes to living the American dream, like more than getting married or having kids, whatever, getting a college degree and any of that. Like owning a home is still a big piece of what people desire. And even as high as these home prices are, like most people within the country would prefer to own a home versus continue to rent. However, it just makes a lot more mathematical sense at the moment to continue to rent, and people aren't getting pushed into home ownership. And when you look at this, this is end of 2025, still like pretty relevant data. The average American, we're looking at a median or a localized median household income. Like 75% of potential home buyers are priced out of the market. We would be anticipating, okay, what's more average? If you can be closer to like, obviously it would be the best case scenario, like the ultimate economic dream is like 100% of people can afford homes in the market, but obviously supply and demand would rebalance that out over time, and sellers of homes would be looking to bump the price. So a balanced market would be roughly 50% of the market could afford a home in their area, but when it's at 75%, like obviously that just prices so many people out. And I was looking at this map of where it's kind of saying the share of affordable homes, and it was going all across a whole bunch of metros in the US here. And I thought it was like, I hadn't seen this data before, like really interesting to note, because like there's really only a handful of cities that are close to balance. Like it's really St. Louis, Missouri, that's at like 49.7% on affordability. You get Cincinnati at about 40%, Louisville about 35%, Detroit around 42%. Pittsburgh is actually maybe the most affordable in the country at 54.6%. That's actually the number 3 market in the country as far as median sales price, though, too. So maybe that's not going to hold up for quite as long, because now people are just trying to push in that area. And so that might actually make it more expensive. And then we look at, man, some of these like really major metros like Boston, 4.8% of people local to the area can afford. New York City, 4.9%. I mean, no surprise there. But just down the turnpike, Philadelphia is about 30%, like big difference compared to New York. And then you would think about some of these more post-COVID boom markets like Charlotte, only about 24% of people could afford homes in that area. Atlanta, only about 31%. Birmingham's a bit better, closer to 41. Miami, I think this is the lowest here. 0.4% of people local to Miami can actually afford a home. Tampa's 11%, Orlando's 11%. New Orleans, you would think Louisiana, poor state, more affordable by a lot of metrics. Only 2.7% of people local in New Orleans can afford a home according to their local median income. Texas, you would think, again, generally, I know it's a bigger boom town, but still more affordable. No. Dallas, 12%, Houston, 15%. It doesn't have Austin on here, probably pretty low too still. San Antonio, 22%. So again, not great. And then you go over to the West Coast, even worse. Phoenix, 16%, Las Vegas, 14%. LA, 0.5%, San Diego, 1.6%. That's actually even worse than San Francisco. San Francisco, at least 7.3% people can afford. Salt Lake, 16%, Denver, 16%, Portland, only about 10%, Seattle, about 9%. And even in the Midwest here, like still not tremendous. Minneapolis, about 31%, Chicago, only about a quarter of people, 26%. So like you saw, I named most of the major metros within the US, and like you could kind of run the numbers. We were saying, about 75% of people are priced out of the market, and about out of all those cities, about 75% of them were like way down the list as far as affordability. Like no wonder people are feeling stressed or only able to rent and not able to afford homes within those particular metros. So I thought that was really interesting data, something I had not seen mapped out before. So just wanted to mention that as well. So again, in summary here, I really hope this gives you an idea on how to think like a statistician, really dive into the numbers and realize when you're being sold a certain story, how to use your critical thinking to determine when you need to go deeper into certain numbers, how to interpret, relative values versus absolute values and relate them back to each other. And again, biggest takeaway, asking more questions. What's the real story here? So hopefully all these examples I went in kind of gave you a better idea on what to look at on your own terms. Again, you can fact check anything that I mentioned here as well on your own, how to utilize AI to help check claims as well, but also knowing when to push back on AI, knowing that it's going to be pulling from biased resources as well. So, it's a constant judgment cycle. It's a constant critical thinking. And, the people who are able to succeed, like, you have to know when to zag when a lot of people are zigging. And if you get people who are just too optimistic about real estate thinking it just goes up forever, it's just not necessarily the case. And they were actually running some math here. Like if you just took somebody who's just renting, average rent versus, getting a mortgage on a home, kind of average home in the US, like we look at retirement accounts later in life, and the renter like vastly outperforms the homeowner here, which, to me, primary residence, I really wouldn't consider that to be an investment when you're paying all the property taxes, et cetera. Like you're always going to need a place to live, but thinking of it as like a core part of your net worth is, to me, a dangerous line of thinking, especially if you have a heavier mortgage on the property and limited equity. But even if you have like full cash buy equity in a house, you could use a HELOC to pull pull out and borrow against your house. But as far as like true liquidity, I just wouldn't view it as much or like a very solid investment asset. I don't think my own house in that regard, certainly. So additional food for thought here on the U.S. real estate market. Hopefully this one was interesting to you all. Let me know in the comments, or DM me if anything was confusing, or if you want to hear more content like this. I'm always open for feedback. Again, you can always submit deals for us to review, seriouslyland.capital, or look out for our Cowork plugin for pricing out land deals, the SLC chat Cowork plugin coming out down the line. And if you want to work with me to implement more AI within your business, I'm taking on a very small number of clients to work with. Again, currently I'm consulting for over our companies with revenue of over $50 million in total on an annualized basis here. So those are the bona fides to keep in mind. With that, subscribe and share, everybody. Looking forward to next time. Bye.